On a quiet Sunday night, the rules of money changed, without a vote, without a war, and without most Americans realizing what had just happened. A president went on television and closed a window that few people had ever seen, yet the entire world had been living by it. The next morning, dollars would still buy coffee, buses would still run, and paychecks would still clear. But underneath the routine, something historic snapped. The dollar was no longer a promise to pay gold. It was a promise backed by confidence. To understand why that announcement mattered, picture the old world first. After World War II, the global economy rebuilt itself around Bretton Woods. The deal sounded clean and almost permanent. The United States would keep the dollar convertible into gold at $35 an ounce, and other countries would peg their currencies to the dollar. If you were France, Japan, or West Germany, you did not need to trust every trading partner. You needed to trust the dollar because the dollar was tied to gold. While it lasted, the dollar's special status looked ordinary. Foreign central banks held dollars as reserves. Global trade settled in dollars. American financial markets became the world's meeting place. In practice, the United States could finance itself more easily because the world wanted its currency. But that privilege carried a pressure point. As the world economy grew, it needed more dollars. And the more dollars the world held, the more it could ask a dangerous question. If we all demanded gold at once, could the United States deliver? In the early years, that question sounded academic because America held vast gold reserves and dominated production. But by the 1960s, the arithmetic turned uneasy. The United States was spending heavily at home and abroad. Domestic programs expanded. The Vietnam War escalated. Inflation drifted upward. Meanwhile, global dollar holdings rose faster than U.S. gold reserves. The system still functioned, but it functioned because people assumed it would. In finance, assumptions hold until someone challenges them. Foreign governments could test Bretton Woods with one simple legal act: present dollars and request gold. Each conversion reduced U.S. reserves and sent a signal. If one country moved first, others wondered if they should follow before the vault thinned. A currency system can survive doubts. It cannot survive a crowd acting on the same doubt. At that point, a gold-linked system starts to resemble a bank with too many depositors at the door. You could see the strain in improvised defenses. Central banks tried to manage gold's market price through cooperative arrangements, and officials spoke about stability, while traders watched pressure build between the official $35 price and what private markets were willing to pay. Every patch told the same story. The world was producing more dollars than the gold promise could comfortably support. The contradiction was structural. The world wanted dollars for growth, but it also wanted those dollars to be as good as gold forever. By 1971, several problems converged. Inflation was rising at home, the U.S. trade balance was strained, unemployment mattered politically, and gold was leaving as foreign holders redeemed dollars for bullion. Each redemption made the next more likely. The system was moving from orderly to brittle, and brittle systems do not fail politely. In theory, the United States could defend the old bargain by tightening policy, cutting spending, and making the dollar scarce again. In practice, that path risked recession, anger, and a political backlash that Washington did not want to absorb. In Washington, the pressure was not abstract. Officials watched weekly reports of gold outflows and the swelling pile of short-term foreign claims. Phone calls from abroad arrived with polite wording and sharp intent. Central banks wanted reassurance, and some wanted delivery. In quiet rooms, advisors sketched the same dilemma on paper. The United States was promising to trade paper for metal at a fixed price, while the world's demand for that metal was rising and the U.S. supply was finite. If the promise were honored too faithfully, reserves would drain and the system would end in humiliation. If the promise were broken, the world would accuse America of changing the rules mid-game. Either way, the break was coming. The only remaining choice was timing. That is why the weekend meetings mattered. The decision was less about economics than about control. Close the window on your terms or wait until it closes itself during a panic. And once you see the choice that way, the next step feels inevitable. Nixon chose inevitability with cameras on and markets closed tight, so the White House looked for a move that would stop the run and force a renegotiation. Nixon met with advisors who understood the choice in plain terms: either protect the gold, promise and accept domestic pain, or protect domestic flexibility and end the gold promise. The drama was that the second option could be done in a single announcement, and the consequences would unfold later. That timing, as always, was politically convenient. On August 15, 1971, Nixon addressed the nation. He framed his actions as temporary and protective, yet in substance, he rewrote the monetary constitution in one broadcast. The first step was the core. The United States would suspend the convertibility of dollars into gold. Foreign governments could no longer arrive with dollars and demand bullion from U.S. reserves. The gold window was closed and the world's anchor was suddenly missing. Then came the second step, a 90-day wage and price freeze. The goal was to restrain inflation and prevent a visible surge after cutting the tie to gold. The promise sounded comforting. Prices will stop. But controls work like a lid on a boiling pot. They can hide pressure, but they do not remove it. When controls lift, distortions tend to appear: shortages, quality cuts, and prices that jump once the lid is removed. The freeze was not a cure. It was a way to buy time while the rules were being rewritten. The third step was an import surcharge, meant to push trading partners toward adjusting exchange rates and sharing the burden of fixing the system. It also played well domestically, signaling toughness and protection. To allies, the message was blunt. The United States would not keep absorbing the costs of the old arrangement alone. 3 moves, one night, and the old system had been replaced by negotiation. At home, many listeners heard toughness and felt relief. Abroad, the news landed differently. Bretton Woods had been a promise that the dollar was as good as gold. Nixon replaced that with a new reality. The dollar was as good as American policy. Gold is a rule. Policy is a reputation. A rule feels impersonal. A reputation has to be earned, defended, and sometimes repaired. The question was no longer, is there enough gold? The question became, will the United States choose discipline when discipline is painful? The immediate aftermath was confusion, then bargaining. Governments had built budgets around fixed exchange rates. Companies had priced contracts expecting stability. Suddenly, everyone had to ask, with urgency, what a dollar was worth without gold behind it. In December 1971, the Smithsonian Agreement attempted to restore order by realigning exchange rates and widening the bands within which currencies could move. It was presented as a new stable arrangement, but markets understood a hard truth. A system that can be suspended once can be suspended again. The old certainty was gone. Within 2 years, major currencies floated. By 1973, the world had moved from a fixed-rate rulebook to a market-based regime where exchange rates shifted daily. This sounds technical until you feel it. Under fixed rates, imbalances forced political choices: tighten, devalue, negotiate, or impose controls. Under floating rates, markets delivered adjustment continuously and sometimes violently. Businesses learned to hedge, banks learned to price currency risk, governments learned that confidence could evaporate between breakfast and lunch. For the United States, closing the gold window solved one crisis immediately. The gold drain stopped. No foreign central bank could empty reserves by demanding conversion. But it opened a larger, longer crisis: credibility. If money is no longer tied to metal, what restrains a government from creating too much of it when spending is popular and pain is unpopular? In a fiat system, the restraint is not chemical or geological. It is institutional: rules, independence, and a willingness to say no when saying no is costly. The 1970s made that point in lived experience. Oil shocks hit, raising the cost of energy and everything energy touched. Inflation became stubborn and psychological. People did not need statistics to understand it. They felt it at the grocery counter and the mortgage office. Once inflation becomes expected, it becomes self-reinforcing. Workers demand raises to keep up. Firms raise prices to cover raises. Lenders demand higher interest rates so they are not repaid in weaker dollars. Households spend sooner because holding cash feels like a slow leak. The spiral is not only printed, it is anticipated. It is tempting to say Nixon caused the inflation decade. That is too simple. Inflation has many roots: supply shocks, fiscal choices, and policy responses. But the Nixon shock mattered because it changed the guardrails. Under Bretton Woods, defending gold convertibility imposed external discipline. After 1971, discipline depended on domestic institutions and political will. When guardrails are removed, the driver matters more, and mistakes become more expensive. The world did not fall apart. It entered a system where judgment mattered more than metal. The Nixon shock also helped create modern finance. Floating exchange rates turned currency trading into a major market. Hedging became a standard corporate function. And the dollar's role as the world's reserve currency survived, but now it rested on U.S. Treasury markets, global dollar banking, and, above all, the Federal Reserve's commitment to protect purchasing power over time. The dollar was no longer a claim on gold, it was a claim on a system's seriousness. That is why August 15, 1971 is best understood as a turning point in trust. Under Bretton Woods, trust was anchored to a number, $35 an ounce. After the Nixon shock, trust was anchored to behavior, what American leaders would do under pressure, and whether they would accept short-term pain to protect long-term value. Behavior, unlike metal, has to be proven repeatedly. The anchor became psychological, not physical. In the years that followed, the United States was forced to prove it could restrain inflation without gold. That proof came later, through hardship, when the Federal Reserve under Paul Volcker pushed interest rates to punishing levels to crush inflation expectations. The world learned a new rule. In a fiat system, credibility is the anchor, and central banks defend that anchor by showing they will not blink when politics demands comfort. The lesson was expensive, which is why it was believed. So return to that Sunday night. A president closes a window. Most people sleep. Money still circulates. Yet the foundation has shifted, from metal to policy, from a fixed promise to a managed reputation. The Nixon shock did not just end a chapter. It began a permanent test. Can a society run the world's currency on trust alone? The answer is never final, because trust is never final. It is renewed or lost one decision at a time. And that is the quiet tension living inside every dollar today.